Kia ora! Welcome to an Introduction to Business. This is part 3 of our series. In this section, we're going to look at income tax and provisional tax. We find most people end up in business because they're good at what they do, not because they're great bookkeepers or mathematicians. At the end of each financial year, an income tax return is completed, and this is how we work out if there's any income tax to pay. Income tax is paid on the net profit or taxable income of your business. The basic calculation is your sales less your expenses equals your net profit. Note that if you're registered for GST, you take the GST off your sales and expenses when you do your income tax. So far in this series, we've been looking at the income minus sales net profit formula. We've looked at the common kinds of expenses and how we treat these if there are business and private use components. Once we've determined our net profit, how do we work out the tax? New Zealand has progressive tax rates. The rates increase as your income increases. These are the tax rate bands. Each individual or partner in a partnership has a portion of their income taxed at the lower rate. Companies have a set company tax rate as they have other ways of making distributions. The company tax rate is 28%. Let's look at an example. In the original example back at slide 1, we had a sole trader whose gross sales were $125,000, expenses of $50,000, which created a net profit or taxable income of $75,000. Let's use those same figures here. The first $14,000 is taxed at 10.5%. The amount between $14,000 and $48,000 is taxed at 17.5%. The amount between $48,000 and $70,000 is taxed at 30%. And the amount from $70,000 to $75,000 is taxed at 33%. Based on a taxable income of $75,000, the tax component is $15,670. Provisional tax is a way of paying your tax throughout the year, similar to how a salary and wage earner has PAYE deducted throughout the year. Once you've completed your first tax return and we've calculated how much tax you need to pay, we can also work out if you'll become a provisional taxpayer. To become a provisional taxpayer, you need to have a tax bill in the prior year of more than $5,000. This was $2,500 but has been increased as part of COVID-19 changes. If your residual income tax or your tax bill was less than $5,000, you'll continue to pay your tax as a single lump sum each year. If your residual income tax or your tax bill was more than $5,000, you'll become a provisional taxpayer. There are 4 options for provisional tax. AIM, or the accounting income method, is a pay-as-you-go option and can be done through certain software. The standard option, which is what we'll focus on today, and there is the estimation option, where you can estimate what you think your tax bill will be and pay instalments based on your estimate. These can be especially useful if you had a great prior year, but you expect this year's profits to be much less. Be aware there may be penalties and interest if your estimate is lower than your end-of-year bill. The final option is the ratio option. You generally would need to have been in business and GST registered for 2 years before you can use this, as we use your income tax return and 12 months of GST returns to work out the ratio to apply to determine payment amounts. Let's have a look at the standard option example. Using our sole trader example, we've worked out that the tax for year 1 in this example is $15,670. And as this is over the $5,000 provisional tax threshold, this sole trader is going to be a provisional taxpayer for year 2 of business. Provisional tax payments are made in 3 instalments. They are calculated by taking the residual income tax from the prior year and multiplying it by 105%. The 5% uplift assumes that the business has an increase in profit year after year. In this scenario, we take the year 1 tax due of $15,670, multiply this by 105%, which equals $16,453. We then divide this by 3, as there are 3 provisional tax payment dates in each year. 2 payments of $5,484 and a final payment of $5,485. Let's plot these on a timeline. Here is our 3-year timeline. We start business at some time in year 1. We reach the end of the financial year, being 31 March. We prepare our income tax return and file this by the due date of 7 July that year. If you have a tax agent working for you, they may have an extension to this date. Our tax for year 1 is $15,670, due by 7 February in year 2. Let's overlap the 3 provisional tax due dates onto our timeline. You can see our 3 provisional tax due dates of 28 August, 15 January and 7 May. You'll often hear the myth that your first year of business is tax-free, which is technically correct, as you don't pay tax in your first year of business, but you do pay tax for your first year of business, but this is paid in year 2. Year 2 is often the hardest, as you have a lump sum to pay for last year's tax and you are preparing the current year's tax by way of provisional tax payments. This is why it's very important to plan and budget for tax. Make sure you are putting amounts aside for these future obligations and to make the second year of business a bit easier. You will start to fall into a routine, making your 3 provisional tax payments. Then once the return is filed, it will work out if you've paid too much or too little for that year. If you have not paid enough, there will be a payment due on 7 February each year. Or if you've paid too much, then a refund will be issued. If you have an accountant, you'll usually have until 7 April to pay any end-of-year tax bill. We've covered a huge amount of content in this series. As a business owner, there are a few other responsibilities to be aware of, such as GST. If your turnover goes over $60,000, you'll need to register for GST. Please note, turnover is your sales, not your net profit. If you employ staff, you'll need to register as an employer and have responsibilities around leave entitlements, PAYE deductions, etc. As mentioned earlier, ACC will bill you directly. It would pay to make contact with them to get an idea of the levies based on your industry. Inland Revenue charges penalties and interest if returns are not filed or paid on time. If you're having difficulty, please contact us as we may be able to set up payment plans. We have a huge range of tools available online that I've talked about today, such as the Cashbook template, Logbook, and the Depreciation Rate Finder and Calculator. There are also demos on how to file returns online. If you have not registered your business for a myIR account, I suggest you do this first. It makes communicating with us or registering for GST or as an employer much easier. Our COVID-19 provisions are changing very fast. We've tried to have this presentation accurate to the day it was written, but things do change. Please go to our COVID-19 link on our website for the most up-to-date information. I can't stress these key messages enough. We're here to help. If you are unsure of something, make contact. Send us a web message through your myIR account. Good records are the key to good business. You know where you've been and where you're at. Being in business is a journey that keeps changing. Plan and budget for tax payments. We've reached our final slide. Check out these websites for further business help. Thank you for joining me and enjoy your journey into business.